OG John AG here. Physical silver demand at SD Bullion explodes to 2.5 times their previous all-time record. SD Bullion just shattered silver sales records in the aftermath of Friday's historic silver price smash. Friday was unlike anything they've ever seen. The market panic and buying surge on January 30th produced the largest transaction day in SD Bullion history. To put it into perspective, they processed 2.5 times more transactions than their previous all-time record. That prior record occurred during the Silicon Valley Bank collapse in 2023. Friday's revenue exceeded what SD Bullion generated in some entire months during 2025. And here's the other side of that story. 1. 8 billion ounces of silver were traded on COMEX Friday. Annual mine production is approximately 800 million ounces of silver. More than double global mine production was traded in a few hours. Meanwhile, the physical market remains tight with multiple dealers rationing silver through different mechanisms. Sovereign mints are already struggling to keep up. New sovereign mint orders are now running roughly 8 to 10 weeks out. 30 days ago, delivery lead times were closer to 2 to 3 weeks. I read every comment across our recent discussions. Thank you. It's powerful to see this community using the information to make sharper, more decisive moves. The range of your strategies is clear. Some of you are preparing for another leg down, while others are firmly anchored in the long-term macro thesis. That division doesn't signal confusion. It shows a community of prepared individuals, each executing their own plan. That's the core of what we do here. Independent thinking, not herd mentality. We don't sell fear, greed, or Netflix-style hype about instant riches. This isn't a scripted show with a predetermined happy ending. It's real markets and real risk. A necessary reminder for all, especially newcomers. I do not sell signals, coaching, subscriptions, or any insider access. Anyone pretending to offer that in my name is a scam. Block and report them. My only aim is to break down what's happening free from bias or agenda. For real-time updates, I am active on X, and for deeper dives on YouTube. You'll find me only as OG John AG on both. That's your guarantee it's me. I am not behind any other accounts, Telegram groups, or private circles. Guard your capital and your information. I will never contact you for money or investment. Let me break down exactly what happened on COMEX Friday. 1.88 billion ounces of silver were traded. That's not a typo. 1.8 billion. Annual global mine production is 800 million ounces. They traded more than 2 years of global production in a few hours. But here's the smoking gun. After all that massive trading volume, most of those contracts were closed by end of day. They opened positions, smashed the price down, then closed the positions. They weren't buying silver. They weren't taking delivery. They were dumping paper to crash the price, then exiting. This is pure manipulation. For comparison, normal months see trading volume around 100% of open interest, maybe 120% on volatile days. Friday, 345%, more than triple normal activity, and it was all concentrated in the March contract, which is a primary delivery month. They dumped unprecedented paper volume to avoid having to deliver physical silver in March. The data points to what silver investors already intuitively know. An unusually aggressive trading session in the COMEX silver futures market, particularly in the March front-month contract. This very likely implies coordinated efforts by large institutional players to suppress silver prices through massive paper selling. A volume of 317,238 contracts, equivalent to approximately 1.586 billion ounces, represents roughly 1.8 to 2 years of global silver mine production. Dumping this volume of silver in a single day, especially during a 40% price route, suggests not organic market activity, but appears to be deliberate price smashing to trigger stop losses, force liquidations, and deter bullish sentiment. Now looking at the numbers, about 75% of you watching aren't subscribed. If this unfiltered real-time analysis is cutting through the noise and giving you a clearer edge in the whole story from both sides and helping you make better decisions, hit subscribe. That's how we grow a community built on truth, not hype. If this adds value, drop OG John AG in the comments. It helps us see what matters to you and keeps this channel anchored in reality. If it's not for you, no hard feelings. I don't chase empty metrics. I'm here for those who want clarity or the polished hype from the mainstream. I won't tell you it's going to the moon and I won't tell you it's going to zero. I'm here for the people who want clarity, substance, not the scripted, shallow talk you'll find everywhere else. Now let's connect this to what we discussed all week. Friday, we had the metals crash. Silver down 31%, biggest daily loss on record. I showed you JP Morgan closed 633 silver short contracts at the exact bottom. They timed it perfectly. They exited. We discussed Kevin Warsh as Fed chair, anti-QE, rate cuts with balance sheet reduction. Markets sold off on that policy shift away from unlimited liquidity. But here's the deeper truth. Friday's 25% silver crash wasn't just about Kevin Warsh or dollar strength. It was more than that. A fundamental driver, yes, but also planned manipulation. Using that driver as a catalyst, they used the Wursch announcement as cover to execute the largest paper dump in history, 1.8 billion ounces, 2 years of global production. And what happened to physical demand? It exploded. SD Bullion 2.5 times their all-time record. The takeaway is simple. When paper silver collapses, physical buyers rush in. The spot price is primarily a paper price. It does not always reflect what is happening in the physical supply chain. Just like banks don't hold all cash for deposits, paper markets trade multiples more silver than exists in deliverable form. That's why you can see situations where paper silver falls sharply, physical demand spikes, physical product becomes scarce, and premiums widen despite lower spot prices. SD Bullion COO Cole Keller recently returned from meetings in Berlin with major sovereign mints around the world. The message from across the global minting industry is clear. Production capacity is being overwhelmed. The Perth Mint has temporarily shut down new sales on key bullion lines simply to catch up on existing obligations. This isn't unique to Perth. Most sovereign mints are facing the same problems. Limited blank supply, higher lease rates, holiday production slowdowns, and surging global demand across the US, Europe, and Asia. As of February 2nd, the reality is new sovereign mint orders are now running roughly 8 to 10 weeks out. 30 days ago, delivery lead times were closer to 2 to 3 weeks. This gap is expected to worsen over the next month as supply pipelines fully absorb Friday's shockwave. In short, if it isn't already in the pipeline, it likely won't arrive quickly. The market has reacted with fear, selling off gold and silver on the assumption that wars will be the next Paul Volcker, raising interest rates to whatever level is necessary to crush inflation and restore total confidence in the dollar. This is a fantasy. It is a narrative that completely ignores the mathematical reality of the US fiscal situation. When Paul Volcker raised interest rates to 20% in the early 1980s, the U.S. debt-to-GDP ratio was a mere 30%. The country could afford it. Today, the debt-to-GDP ratio is 125%, and it is rising at an exponential rate. The U.S. is adding $1 trillion in new debt every 90 days. Annual interest payments on the national debt have already surpassed $1 trillion, and they are on track to become the single largest item in the federal budget. The math will be making decisions for Kevin. He can't be Volcker even if he wants to. The debt load makes it impossible. And here's the other massive development nobody is connecting. The U.S. is launching a $12 billion strategic mineral stockpile to counter China. Lithium, nickel, rare earths. Silver isn't mentioned, but make no mistake, silver is right in the middle of this story. Notice how they're still afraid to mention it directly. EVs, solar, electronics, defense. There is no energy transition without silver. When governments start hoarding physical materials, it's not because prices are stable, it's because supply risk is real. Paper prices can be managed. Physical availability cannot. Strategic stockpiles mean one thing: just in time is dead. Custody is king. If you don't hold it, you don't own it. Trump also announced a major US-India trade deal after a call with Prime Minister Modi. India stops Russian oil purchases and switches to US plus Venezuela supplies to help end the Ukraine war. US tariffs drop from 25% to 18%, and India cuts tariffs and barriers to zero. India commits to massive Buy American purchases worth $500 billion in US energy, tech, and coal. This is massive for commodities. India absorbed 25% of global silver production in 2025 with inelastic demand. Now they're committing to $500 billion in US purchases. Where does silver fit into US tech and energy exports? It's embedded in everything: solar panels, electronics, EVs. India's demand isn't going away. It's accelerating, and the US just secured a $500 billion deal with them. And US ISM manufacturing PMI just came in at a 40-month high of 52.6. Expected was 48.5. The ISM above 50 is bullish for markets. This is strong economic data. Manufacturing expanding. Industrial demand for silver rising, yet silver crashed 40% Friday. Funny how after a strong USI ISM, copper and silver prices went in the opposite direction than what common sense would suggest. This confirms its manipulation, not fundamentals. Current prices, as I'm recording: Western spot at $80. Shanghai spot at $1,000. Western futures at $80. Shanghai futures at $95. That's a $20 premium on spot and $15 on futures. 26% premium. After a 40% crash, the premium is still over 25%. The physical market is not following paper. Now, let's talk about what could still go wrong, because the bearish case is real. UBS says silver's 26% drop, featuring intraday swings of nearly 38%, marks one of the most extreme moves in decades, with volatility approaching levels not seen in almost 50 years. This is brutal. If you were trading on leverage, you got destroyed. Natural gas prices just crashed 25% to a 2-week low. Copper tumbled more than 5% amid broad metal sell-off. The entire commodity complex is under pressure. Conx raised margins effective after close February 2nd. Gold non-heightened risk from 6% to 8%. Heightened risk from 6.6% to 8.8%. Silver non-heightened risk from 11% to 15%. Heightened risk from 12.1% to 16.5%. Shanghai Gold Exchange also raised its margin requirement from 20% to 26%. More margin hikes, more forced selling potential. The timeline is flooded with Epstein files and war threats. But look closer, not a single person was arrested and no war started. This feels like a giant distraction to hide something much bigger, and we're all about to find out what it is. U.S. stock market concentration is at record levels. The S&P 500 Hendel-Hirschman Index is up to 195 points, near the highest on record. This metric measures how evenly market value is distributed across all 500 stocks. A higher number indicates increased concentration. This index has more than doubled since the 2020 pandemic. By comparison, the HHI index peaked at 125 points during the 2000 calm bubble. The market has never been this top-heavy. When this breaks, the deleveraging will be catastrophic. That's the bearish scenario. More selling, more liquidations, more margin hikes, economic stress, everything crashes together. But here's why the bullish case for physical is overwhelming. SD Bullion 2.5 times their all-time record. In one day, Friday's revenue exceeded entire months of 2025. This is not speculation. This is verifiable retail demand data. When paper crashed 40%, physical demand exploded 250%. Sovereign mints overwhelmed. Perth Mint shut down new sales. 8 to 10 week delivery times up from 2 to 3 weeks 30 days ago. Limited blank supply, higher lease rates, surging global demand. If it isn't already in the pipeline, it likely won't arrive quickly. This is the physical bottleneck we've been predicting, and it's happening now. Every major gold bull market has had brutal mid-cycle corrections that felt like the end. The 1974 correction was negative 47%, nearly half the value wiped out. Everyone declared gold dead, and then it ran 734% over the next 6 years. The current 16% pullback in gold is actually modest by historical standards. In the context of the 1970s, this wouldn't even rank among the top 5 corrections, and critically, none of the structural drivers have changed. Tether is still buying, central banks are still accumulating, debt is still expanding, silver remains in backwardation. You can't cure a huge physical shortage by manipulating the paper price. The manipulation has nothing to do with physical supply and demand. Making sense of Silver Friday's utterly rigged nonsense, high turnover, and position closures. With volume at 345% of the closing open interest, the March contract saw extreme turnover, meaning positions were opened and closed rapidly, likely amplifying downward pressure. After the session, 1.127 billion ounces worth of contracts were closed, leaving only 459 million ounces in open interest. This implies many traders or institutions exited or rolled positions to avoid physical delivery obligations in March, a primary delivery month. Speculative short selling dominated as high volume without proportional open interest. Increase often indicates bullion bank day trading or algorithmic piling on during the sell-off. March being a key delivery month amplifies the stakes. The sharp open interest reduction post-volume spike suggests many contracts were closed to evade delivery, potentially avoiding a squeeze where shorts must source physical silver. However, if standing deliveries remain high despite this, it could strain vaults as soon as March's COMEX registered silver stocks are down to just 104 million ounces. 104 million ounces registered. 1.58 billion ounces dumped Friday. Do the math. If even a small fraction of those contracts demanded delivery, the system breaks. The cartel's efforts to suppress silver prices in the midst of a historic inventory squeeze risks, igniting a backlash and the potential for a much higher eventual blow-off top in silver prices. Physical silver demand was already in a 5-year deficit, and silver demand will only surge in response to industrial users and investors suddenly being offered an unexpected 40% off sale on silver. The bullion banksters have bought themselves time, but they are digging their eventual graves even deeper. So where does this leave us? Number 1, 1.88 billion ounces of paper silver dumped Friday. That's 2 years of global mine production traded in hours. 345% turnover in March contract. 1.127 billion ounces closed to avoid delivery. Conx registered stocks 104 million ounces. The paper market dumped unprecedented volume while physical demand exploded. SD Bullion 2.5 times all-time record. Sovereign mints 8 to 10 weeks out, up from 2 to 3 weeks. This is the paper physical divergence at its extreme. Number 2, the worst narrative is a fantasy. Markets sold off assuming he'll be Volcker, but debt to GDP is 125% versus Volcker's 30%. U.S. adding $1 trillion in new debt every 90 days. Interest payments already $1 trillion annually. The math makes Volcker impossible. Meanwhile, Trump launches 12 billion strategic minerals stockpile. Silver not mentioned, but it's the core of the story. EVs, solar, defense, no energy transition without silver. Governments hoarding physical means supply risk is real. Paper can be managed. Physical cannot. Number 3. Historical context matters. 1974, gold corrected negative 47%, then ran 734% over 6 years. Current pullback is 16%, modest by historical standards. None of the structural drivers changed. Central banks buying, debt expanding, tether accumulating, silver and backwardation, physical and 5-year deficit. Friday's 40% crash triggered 250% explosion in physical demand. When this paper manipulation breaks, the rebound will be historic. The unresolved tension is this: 1.8 billion ounces dumped, physical demand exploded, delivery times tripled, mints shutting down sales, but margins hiked again. Volatility at 50-year highs, economic stress building. Does the paper manipulation continue squeezing over-leveraged longs, or does the physical shortage finally overwhelm the system? March is a primary delivery month. Conx has 104 million ounces registered. If standing deliveries strain vaults, the squeeze we've been tracking could ignite within weeks. Do your own due diligence. Understand the risks. This volatility is a meat grinder for leverage traders. But if you understand what's happening, 2 years of production dumped in hours while physical demand hits 2.5 times all-time records, then you know this isn't about fundamentals. It's about desperation. They bought time by dumping unprecedented paper volume, but they're digging deeper graves. Physical will win. The only question is when. Invest with logic, not hype. Use your own brain. Don't follow anyone blindly. OG out and